This is not a clickbait video. I actually believe the sentence when I say, don't invest for cash flow. Howdy. Welcome back to Dion Talk. Why I do not and have not invested for cash flow. A lot of times I get the question from a new investor of, how much cash flow per door do you get? Or I hear investors say, I only invest for cash flow. And this makes sense if you think they're comparing cash flow to something like appreciation or status. But I don't invest for cash flow. When someone asks me how much cash flow do I get per door, it kind of tells me that they don't understand investing. If this is your first time to my channel, my name is Dion. I reached financial freedom in less than 10 years, even though I wasn't starting from a good position. And my goal is to teach each one of you how to do that. And if you are doing something like looking for a certain amount of cash flow per rental that you buy, you probably won't reach financial freedom in 10 years or less. It might take decades longer because that's the wrong metric to look at. There could come a time when I invest for cash flow.
But not today.
But it is definitely not when I'm building a portfolio and trying to reach financial freedom. There's a different metric that we use. Let me explain first why cash flow might not be the best thing to use. Some people say, I want to get $100 or $200 per door in cash flow. Does that tell you if it's a good or a bad deal? $500 a door wouldn't mean that it's a good deal. If you use something like a VA loan or an FHA loan to buy a triplex or a fourplex and you're making $100 or $200 a door, it could look like a good deal. But if you invested $100,000 or $500,000 into a property to then get $100 or $200 a month in profit, does that sound like a good deal? So when we talk about cash flow, yes, to me, cash flow is more important than appreciation. So if you're saying, what do you invest for, cash flow or appreciation? I would say cash flow, because I'm being pigeonholed into saying that that's what I'm investing for, but it's not actually what I've invested for. What I actually invest for, what really matters to me, is yield. It's an accounting term that talks about how much money you make based on how much money it costs to invest. So in real estate, we call this a cash-on-cash return on investment. It could have good cash flow, it could have bad cash flow, and still be a good or a bad deal. Sounds confusing. I totally get it. But with yield, what we do is we look at what was the cost to acquire? How much did it actually cost me to acquire this asset versus what am I actually going to make in a year? Now, the cash-on-cash return isn't quite profit. Profit includes things like appreciation, principal pay down, that internal rate of return that looks at everything, that makes a real estate deal look amazing. But when we're just talking about cash flow, I'm hoping that I can get you to start thinking in the terms of yield. And the quickest way, the shortest way to put the math into this video, because I know as soon as I start talking math, most people's brains shut off because mine usually does too. Cost to acquire is not just your down payment. It's everything that you put into this investment. It's not what you spent, because we're not really spending money. Most of it we're moving from the bank into the property because it's still there. It's still yours. You can sell. You can cash out refinance. You can take out a home equity line of credit. All of that money is still yours, but it's now in the property. But you have the down payment, closing costs, money for immediate repairs, right? How much money, how many dollars did you put into play to acquire this asset? And sometimes that can include repairs that you know you have to do after you purchase, like putting a roof on the property. Annual profit is all of the money that comes in. Your rents, if you have paid coin laundry or paid parking or using storage for the sheds on your properties, any way that you're making money, subtract your mortgage payment, so your principal, interest, taxes, and insurance, and setting aside for things like repairs, maintenance, vacancy, property management, if you're going to use it. You take all of those funds out. What's left every month, you get all your rents and all your income, you take out all of your expenses, including those expenses that are going to come up in the future. You need to pick a percentage that's going to work for you. I do 10% for repairs and maintenance and 5% for vacancy. So when I'm looking at a property, 15% of gross rents is being calculated as being set aside for expenses. What's left is your monthly profit. You times that by 12 to get your annual profit. Your annual profit divided by your cost to acquire will get you your yield. If you invested spent, however you want to look at it, $100,000 to acquire a property, and you make a profit of $10,000 in a year, not the appreciation, not the principal pay down, just the money that comes in after all of your expenses, then that $10,000 would get you a 10% yield. So this isn't an amount per unit, per door, per property. It is the money that you made in cash flow for that year divided by how much it costs to acquire that property to get that yield. My goal with yield is to learn the market that you're studying, figure out what is kind of an average yield for a good deal in that area, and then try to beat that. My first goal was to purchase single-family houses. I thought, I own a house because I purchased it long before I was an investor, when I was just buying the house to have the little white picket fence to raise a family in, but decided to become a real estate investor and was looking for rentals. I had a bad debt to income ratio. I had low income. I had been laid off from a police department in 2008. I started teaching truck driving at a truck driving school, making $17 an hour. So I found out about $89,000 in bad debt in my name I didn't know existed till the divorce. I was a single parent with 3 kids. I just wasn't in a good position to buy a rental. So based on the recommendation of a lender I talked to, I moved into an apartment and rented out the house. The lender said if I had rental income on my tax returns, my debt to income ratio and my income would almost become irrelevant when it comes to buying a property, because the rental income on the property could count in my ability to purchase that house. And then I ran the numbers. Even if I could find a house that generated some cash flow, it was a bad yield, close to zero. And most times negative. I would lose money owning single family houses. So I moved into buying small multifamily, like a duplex, triplex, fourplex, or a house with an ADU. I kind of have a little bit of all of that. I actually have a triplex that is a house and an ADU. It's a duplex and a house on the same property. I don't know which one's the ADU. But those had a positive yield. And I could find consistently, if I looked at 100 deals in my area, about 80 would suck and lose money, no matter what I did with them. 20 would kind of get a good yield, somewhere between 7 and 8% cash on cash return on my money, based on that equation that we talked about. So I shot for 10s. If your market, you can find 4 or 5% fairly consistently, at least 20 deals out of 100 maybe, look for 7s or 8s. If you're like Matt the Lumberjack Landlord that's able to find 15 to 20% deals, you look for 25 or 30%. You're trying to beat that average based on yield, not cash flow per door. So I talked about at the beginning of this video how eventually I might invest for cash flow instead of yield. While I was growing my portfolio, it only made sense to put my money to its best use, which meant getting a good yield in my area. It can't hurt to have a minimum cash flow. If you can find a property that's so cheap that you're going to get a good yield, but you're going to have high turnover, it's in a war zone, you can't go there safely, you don't want to be responsible for sending a property manager or handyman or contractor there because it's not in a safe area, you might have a minimum cash flow that you look at too. I haven't had to do that because I invest in kind of a higher cost of living area where that 10% return is easily $400 to $600 a month in cash flow per unit in the first year. By year 3 or 4, they tend to be around $1,000 a unit in cash flow. Rents go up, mortgages basically stay the same. It's one of the benefits to owning real estate long term. But I reached financial freedom at the age of 52 and last year retired in July. So I've been retired a little bit over 6 months now. While growing my portfolio, I focused on yield. But I am not looking to have a huge portfolio. I am not investing to create generational wealth. The best thing I can do for my kids is to not become a financial burden for them when I'm too old to work, which is now because I'm not working anymore ever again in my life. So reaching financial freedom was part of my goal to not become a financial burden to my kids. It wasn't to leave them a big inheritance. I think inheriting a large amount of money can actually kind of ruin people's lives. So my kids will inherit what I have, but it isn't going to be me investing specifically to get them a better inheritance. I reached financial freedom. I have 16 rental units. My cash flow is a little over $17,000 a month. It costs me about $4,000 a month to live. So I'm kind of trying to learn how to spend money. I'm not spending that much. So the money is piling up. My next investment, I might not look at the yield as much as I look at the cash flow. Remember, don't compare year 12 now to year 1 or 3 or 5, because while you're growing a portfolio, This is not a clickbait video. I actually believe the sentence when I say, don't invest for cash flow. Cash flow is a side benefit of investing for yield. Later, when you are in a different part of the timeline in your investing journey, you might invest for cash flow. Buy a property all cash. The more money you put into a deal, the more cash flow you're going to get, but the lower your yield is. And Michael Zuber from One Rental at a Time says this really well. When you're looking at a rental, which do you prefer? A single family house, a duplex, triplex, or fourplex, small multifamily, or a large apartment complex? And Mike says it perfectly. He says, which one has the best yield? I hope this video at least made you think. Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.